So somebody who want to get into a trading profession, what is the first advice or suggestion you would give? The word you have said, it's trading is similar to a performance activity, right?
Yeah.
Before I ask you all the questions, any kind of performance activity, as you rightly mentioned, uncertainty and the pressure builds automatically. Strategies and systems we can define. How do you define and understand with respect to trading psychology, which suits my style? Most of the traders think that it's all about indicators, it's all about strategies, but when it comes to trading, I personally believe, and the fact is that 80% of the people fail because of the trading psychology issues. Today we have our one another than Enzo Calamita, who is our trading psychologist from our floor, helping all the students, helping each and everyone who meets, and with Enzo sharing his wisdom throughout the day, throughout the journey. Enzo, welcome to this podcast. Welcome to this video session which we are doing for our audience.
Thank you. Great to be with you.
Thank you so much for accepting the invite first and foremost thing. And so, could you please take us through your journey? How did you started with trading, and how was your childhood experience? Could you please take us through your personal journey first and foremost?
Yeah, it's been a long journey, a journey that I'm still on. It took me quite a number of years, probably about 5 or 6 years before I started to experience any profitable periods in my trading. And as I've gone on my journey, I've just realised more and more that although strategy and method is important, if you cannot get your thinking right and the management of yourself, even the best strategies ultimately fail for a trader, simply because they can't execute it in a consistent way.
Okay, that's great. So, when have you understood the fact that trading psychology is important, and when have you started your personal journey into trading psychology, more about it, learning more about it?
I would say definitely in the last 2 or 3 years it's become really at the forefront. So I spend as much time on my mindset as I do on my refining my trading method.
Okay.
And I would say the reason for that is that I've just realised that if as a trader you are executing day to day, you're involved in a performance activity, and performance activity takes place under conditions of pressure and uncertainty, akin to a professional athlete. So that creates certain challenges that strategy alone doesn't answer. Those skills are necessary skills, needed skills, are also psychological and emotional.
Okay, great. So when I asked this to our community people that I'm going to meet with you and discuss about something interesting, I've said that I've collected a couple of questions from them. I'll ask those questions, but before that, the word you have said, it's trading is similar to a performance activity, right?
Yeah.
Before I ask you all the questions, any kind of performance activity, as you rightly mentioned, uncertainty and the pressure builds automatically.
Yeah, I mean, when you're having to make decisions. So there's even if you're a systematic trader that's quite automated, assuming you're not 100% automated, you're having to make decisions, and those decisions are being made under conditions of pressure because you've got money on the line, and uncertainty because no trader deals in certainties, we all deal in probabilities. So therefore, you're engaged in a performance activity, and because of that, it creates certain psychological and emotional challenges, not just intellectual ones.
Okay, great. So say for example, as you said, any performance, if you take any sports or any kind of performance, we can see only finger count people are on the top list. Rest everyone tries, we will get unrecognized. So somebody who want to get into a trading profession, what is the first advice or suggestion you would give to them?
In the early stages, you have to educate yourself, learn as much as you can, and ideally find someone who's ahead of you in the game, a good coach or mentor. And at that point, in those early phases, I always recommend experimentation. So you maybe want to experiment with different types of trading to see what you think might suit you. And then, at some point, you're going to find that hopefully a style and a method that works for you, and then your job is to then refine that and to work on being able to execute that to the best of your ability.
Got it. So finding my trading style with respect to whether I'm a scalper or a momentum or intraday or a positional, with respect to strategies and systems, we can define. How do you define and understand with respect to trading psychology, which suits my style? Do we have any sort of experiments or exercise to understand, okay, this style or psychology suits me, or can you recommend any of them?
One of the things I think that we need to state, that maybe a lot of people don't realise, is that generally, if you want to be a very short-term trader, and I mean by that, a scalper or an intraday trader, my view is that carries much heavier psychological challenges than longer-term trading in general.
Okay.
So, to want to be an intraday trader, nothing wrong with that, but recognise that usually the shorter your holding period, the more you can be prone to mistakes due to psychological and emotional factors.
Okay.
And the pressures that creates. Obviously those pressures exist for any type of interaction with the market where risk is present, but when you're having to operate at that level of speed, the intraday trading is more challenging, and the research and statistics that we have show that the intraday trading carries the highest failure rate amongst all types of trading.
Okay.
So I think the evidence also bears that out.
Yeah, in India, when I have read the SEBI report, last time 93% of the people lost money, and on an average they lost around 50,000 rupees. And nowadays, when I try to open an account, it will still show me that, okay, this is the stats, you should understand it before proceeding further. Like CFD, the risk warning, 72% of the people lose the money. Accept it before you start proceeding further, even though it's like smoking, injurious to health, saying or drinking alcohol is injurious to health. People know that, but the same category of people will keep on still trying. I had a question with one of my community member asked, I'm able to hold losses up to a certain limit, let's say $50, but I'm not able to hold a position up to a $10 profit. What might be the reason for this?
It's psychological in nature, because we are psychologically we are wired to pursue pleasure and avoid pain.
Okay, pursue pleasure and avoid pain.
Correct.
Okay.
Which is why when you're in a winning trade, you want, usually, again, it depends on the person's method, but what will immediately give you satisfaction is to take that profit.
Yeah.
So we have, rather than delayed gratification, we are wired towards instant gratification.
Okay.
Right? That's why everyone likes, a lot of people can't stop eating cakes and sugar and stuff, because it gives you that instant hit, that dopamine hit. So when the profit is on the table, a trader may, in his plan, have told himself that he's holding for a certain target, but he might see that profit starting to temporarily, that open profit anyway, starting to temporarily diminish, and so he wants to avoid the pain of that loop of that winner going back to break even or turning into a loser. So rather than wait for target, if he works with targets, he'll pursue the instant gratification of that pleasure. Vice versa, if you're in a losing position and you should have got out, because you're wired to avoid pain, there's the hope that the loser will come back. So again, you're avoiding pain by not taking the loss when you should, or when your plan said you should have done. So a lot of these behaviours are rooted in our wiring. Good trading is usually uncomfortable. In fact, I would say most good trading is uncomfortable. So you will need to work on doing what is actually not coming naturally to you.
Okay.
So
So I completely understand this. Say for example, avoiding the pain and seeking the pleasure. That's the main reason. So is there any way for any kind of trader to practice avoiding this pleasure and accepting the loss? People say that most of the people accept the loss and move on, but most of the traders, it's a challenging job.
Yeah.
So do you suggest any kind of medication practices or any kind of techniques?
Well, first of all, you can start with the methodological aspect of it. So if someone is relatively new to trading, my recommendation is that they trade with predefined rules that are very strict. So for example, they have a predefined stop loss and profit target on their trade, and their rules say, in this instance, that they only exit at stop or target. So that way they're practicing the discipline of sticking to their rules. As they mature as a trader, they can learn to bring in a lot more freedom. But what that will do in the early stages is teach them discipline.
Okay.
So they'll have to sometimes bear seeing a trade go to maybe 1-to-1 and then hit their stop.
Okay.
And what that will do is train them. As far as the emotional side, there's a number of strategies that I recommend. Time to go into them today, but that there are things we can do to help to improve our emotional self-regulation and our psychological prowess, strength and so on.
All right. As we already said, that discipline and the rules. Most of the people think that I don't want to work under a boss. I don't want to go to the 9-to-5 loop. And trading is a way to escape from all these, places. And they come to the market, which they can open an account within fraction of seconds or minutes. They start this business and think that they have seen the profits or loss, and they think that they are in the game. But when it comes to discipline and the rules, that's why they have avoided all the other roads and they have come to the trading. What is the first message or certain parameters, if you say, like you always suggest of going with the 100 trades, with that is going to be hit their stop loss or target, something like that. What is the suggestion you have for them?
So what you said at the beginning, a lot of people come to trading for the freedom. And when you open a trading account, pretty much within certain parameters, you have the freedom to do all kinds of things. But the irony is that the freedom in trading and then the freedom to make money actually comes from the discipline. So a lot of people think that freedom is the opposite of discipline, because discipline makes people feel the thought of being confined, being rigid. But it's actually by adhering to certain fixed rules, especially in your early trading. I think as you develop, you can move on a trajectory where you have more and more freedom. But in the earlier stages, it's better to have parameters and boundaries. So the market's not going to take your hand and give that to you. So what you have to do is put those boundaries down yourself. You mentioned about executing a series of trades. So what I always recommend traders to do is to have a system, to have a plan, and to consistently execute a trade over and over again. Not many different trades in the sense that, but following a very similar procedure each time they trade, like a similar setup, which will help them to cultivate the discipline to focus on the art of trading itself and not be focused too much on the money and the outcome of a trade, but rather the process of the trade. So basically working on becoming a good trader, and the money will follow.
Okay, from the last video discussion or the kind of discussion we had, I've used the technique which you said,
right.
Holding the winners.
Yeah.
Imagine myself when I wake up, imagine I'm holding a good position and riding that position.
Okay.
And imagine myself, if I'm wrong, cutting the losers. But still, I face challenges while doing that. Even I've posted a quarterly plan created for this quarter, let's say 260 trades for this quarter for 13 weeks. Every day, if you take even 4 trades and 20 trades in a week, and 13 weeks, you get maximum 260 trades.
Right.
With the 260 trades, 50% of them is going to be like more or less scraps, break-evens. Other 50%, about 130 trades, if I'm able to ride at least 10% or a 20%, I'll still be able to in a great winning, for this quarter. So like this, could you please suggest anyone how to approach the market with suiting to each style of trading psychology?
When it comes to the actual trading system, really there's usually two ways of approaching it. Some traders go for a high win rate, and usually most trading systems with a high win rate, the risk to reward is smaller. So generally systems that have win rates of say above 60%, the risk to reward might be 1-to-1, maybe 2-to-1 would be very impressive, but maybe even inverse. So maybe you're making half a point for every point you risk. So that's a system that has a high win rate, so where you're winning most of your trades. The alternative to that is a system with maybe a lower win rate. So there's a lot of traders out there who have win rates of say 30% or even less, maybe a bit more, 35%, but their winners are bigger. So they might have a win rate, they might have a risk to reward of 3-to-1. So I mean, if you execute 100 trades at a risk to reward of 3-to-1, assuming your position size is equal, then that's a very profitable system, because 30 trades will give you 90 points. And minus the remaining 70 losers nets you 20 points plus. So if you were risking 1% per trade, you're 20% up, and you've lost most of your trades, assuming you've stuck to your risk parameters. Now, the psychological challenges of a system like that are much greater, because you have to be willing to lose a lot, and losing doesn't come easy to people. Even if you accept intellectually that losing is okay, when you're actually in the plan and you're having loss after loss after loss, yes, intellectually you can accept that, but your emotions will get triggered, and that's where you have to work on being able to deal with losses in a healthy way.
Most of the people would have heard the same message from different YouTubers, podcasts, or whatever the source of knowledge which they are getting.
Right.
Use 1:3, 1:2,
Sure.
or 1:5.
Right.
But realistically, if I take 100 people, I haven't seen 80% of them following the same. They know the 1:3 and 1:5 or 1:2.
Yeah.
But they don't follow this one when
Yeah.
it comes to actually place the trades.
Sure.
So is it better if I place my trade and put the stop loss and target and leave the system? Is that
It is if you're learning I think in the beginning, you see, because there's the theoretical and then there's the experimental.
Okay.
So in theory, this sounds quite easy, but anyone who's done it knows it's not easy.
Yeah.
So it takes emotional and psychological fortitude to execute a system consistently, because the temptation to violate your rules when you're under pressure, when you're feeling emotional, when you're tired, will be there. So the goal is to execute it consistently, but it's not as easy as it sounds. So effectively, you're going to be getting a good workout. The truth is though, many traders don't even go in with a plan in the first place. At least if you go in with a plan, once you've executed it, you can evaluate and say what you did well, where you need to improve, and you can be in a cycle of continuous improvement. But too many traders, they disappear down rabbit holes and find it very hard to stick to a plan like that. But that's the way forward. That's how you grow.
is that one solution might be, say for example, if I am taking 10 lots of any trade, if I reduce my risk size or this position to one lot, even 0.01 lot, will that help me to ride the profit or let it go for 1:3 or 1:5?
If that's what you need to do in the early stages to develop those skills, I think it's like going to the gym. If you haven't been to the gym for a long time, you don't go in and lift hundreds of kilos. You might start with 20, 30 kilos or whatever. And once you've comfortably done that, you raise. And it's the same in trading. So you may even start on a simulator, then move to very small amounts of capital. And as you build that self-trust, you then incrementally grow. You don't want to go from risking, £100 a trade to risking £1,000 a trade. It's quite a big jump. So usually you should migrate. I think you have to put the work in and pay the price to grow in this sphere.
Got it. Thank you so much for that wonderful answer, because most of the people say that, okay, I am just trading with 1:3. Now they know that they have to have a reasonable set of series of trades which proves them, okay, this is what I'm trading.
Yeah.
When it comes to risk management, I'm going to deviate from the questions to our E2T prop,
Okay.
which we have launched a couple of months back, and people are trading with that, and people are facing challenges because they have never ever seen a daily drawdown of 2%, and they don't know how to manage.
Right.
So for them, what would you suggest? If I have a capital, let it be X amount,
Right.
I have to manage it within 2% of risk.
Right.
How do I do that?
Well, when it comes to funding challenges, they are hard. They're tough challenges, but if you respect them, they can actually help your trading to improve. So, at a basic level, for you not to risk 2%, to go above 2% risk a day, you have to ensure that you have, let's say you're a day trader, you have to ensure that you have a daily loss limit. So if, for example, you allow yourself, your system says you can take 4 trades a day, or 3 trades a day, then you have to ensure that the loss on those trades would never exceed the daily limit.
Okay.
So, what would you, to keep it within the sphere, maybe you would risk no more than 0.25%, or maybe at the most 0.5% on a trade. Obviously, if your drawdown is very, very tight, then you need to be trading a lot lower, because you're basically always, some people they do funded challenges with, they say, a 5% drawdown, and they're risking 1% a trade. Well, you might get away with it, but the chances of you blowing are very, very high, because you're only 5 trades away from, if it's 5% and you lose 5 trades in a row, which many great systems, in fact, most systems, the best of them, will have a period where they have 5 losses in a row, if you trade it long enough. So the chances of you losing that challenge are very high if you're risking that much. So you have to lower your risk and think strategically about your limits, so that you're always able to trade another day.
See, because most of the people who got the payout, rather than failed people, I'm just ignoring them because they haven't put the right time and effort.
Yeah.
But the people who have got the payout, and have observed, when sitting with the risk manager, there is a pattern. They are not in a rush.
Right, exactly.
They know that, okay, I have enough time to proceed it further.
Yeah.
And they know that, okay, I can have small wins with respect to very little lot size.
Yeah.
And try to gain the momentum, and eventually they have paused.
Yeah.
None of them have tried putting a large trade and winning this challenge as soon as possible.
Exactly, yeah.
So I really want to share this message along with your input.
Right.
People who try with the prop account, whether it can be E2T or any prop account, they have to keep a plan in place and execute the plan. But here, the people who have passed, they have got their next level account. Let's say, for example, if I'm trading 10K account today, and if I hit my 10% target, I get 80% of my payout.
Right.
And then I can scale my 10K account to 20K.
Correct. Yeah.
From 20K to 40K. And it goes all the way up to $1 million account.
Right.
But mathematically speaking, if I have a 12 consecutive period where I can scale from a 5K to 10K, it takes only 84 days. So 7 days to get my first payout, which is 10%, and 12 consecutive periods, I'm reaching like a 250K, a 5K capital which can grow. What would you say that, to set a mindset concept in order to achieve a 250K starting from a 10K for us? Anyone who starts with E2T.
Well, my view is you have to take the tortoise approach. The story of the tortoise and the hare. There's a phrase that says, the man who wants to be rich in a day will be hung in a year. If you're in a rush to make money, in the end, that speed is going to catch up with you, and you're very likely to blow your account. Or you may get so far, but you'll be likely at some point to lose the account you've built. So you have to protect the downside. And the main way to do that is you have to manage your risk. So yes, it takes longer. Yes, you can pass sooner by risking a lot more, but it's not sustainable. Eventually, you're going to be caught on the wrong side of something like that. And some traders get away with it for a long time. But you're better to serve yourself to be a better trader and to be more conservative. I'm not saying not to be aggressive, but you need a balance of aggression and being conservative. And so you have to pace yourself and know that this is not, it's not overnight. Give it time, trade in a, responsible, risk managed way.
I've read somewhere like, having a stoic mindset.
Stoic,
or having a personalized approach for us. Have you done any sort of meditation for yourself to improve your trading psychology?
I'm not a big expert on meditation or anything like that. But one form of meditation I found helpful, which just keeps you in a state of kind of observing yourself, is like mindfulness meditation practice. And I think that can be good for traders because it's very easy for us to get caught up in our thoughts when we're trading and not get some distance from what's going on. Very easy for the emotions to hijack the thinking brain. So having a mindfulness practice, maybe in the morning or evening or before you trade, just helps to get you into that kind of balanced state. I won't go into the details of how you do that. Anyone can go on YouTube and just type in mindfulness meditation and they'll find great material or guided ones on how to do that. The other thing, believe it or not, I think is you need to be breathing deeply ideally when you're trading, especially when you're in a trade, because the emotional brain starts to get triggered when the breathing starts to shallow down. So you can basically reset your fight, flight, freeze response and to some degree your nervous system by just ensuring that you're breathing. It's amazing how many traders, if they actually stopped and looked at their breathing when they were in a difficult situation or when they were engaging in some kind of destructive practice, they'll find that their breathing has gone very shallow or stopped altogether. And then the thinking brain gets starved of oxygen, and then the emotional brain takes over, and at that point you actually lose control because the emotional brain is much more powerful than the thinking brain.
Okay. All right, let's get into some more questions. One of our community member, who's a great trader I've seen myself, he has more than, let's assume a 50K. I'm not putting the right value so that people won't reach out to him saying that, okay, you have 50K. So he has around $36K dollars, and he puts very less quantity, but he averages all the losing trades. He has made 50% profits in the last 3 months, I would say. But still, he knows the fact that he's doing wrong.
Okay.
But he is making money.
Yeah.
He does not close any positions until and unless it turns into his favor.
Sure.
Is this a right approach?
This is a tricky question because it all depends on the trader's risk profile. So let's assume that we believe that investment is a type of trading. I know some people would disagree, but effectively, even in an investment, you are buying something in order to sell at a profit at some point, even if you're holding the asset for decades. So in investment, the idea of averaging down or just averaging into an asset, wherever the price is, makes a lot of sense. And people have done that, say, with the S&P 500. And over the last however many decades, it's averaged every year, 10% per year. But with that, they have a very long holding period time trajectory. Now, if you're doing more short-term trading and you do that, the problem is if you're using, I'm not sure what type of leverage he's using. If he's using aggressive leverage and he
might have 1:100, I guess.
Okay, the issue then becomes that depending on if he's not managing his risk carefully because of size, if he's actually just averaging in, the truth is that a lot of traders will get away with that for a long time because the price will usually at some point come back. The problem comes that at some point it doesn't. If you do it long enough, at some point you get caught out. And if a trader is using excessive leverage and doing that, many traders have experienced catastrophe, margin calls and liquidations because of that. If your risk is very small, so for example, if I've got £100,000 in my trading account and I average into an asset with say £2,000, £3,000, £4,000 position size, I know I can't ever lose more than £4,000, which as a percentage of the account is manageable. But if you've got a £100,000 account, you're leveraging 10 to 1 and you're averaging in at position sizes of say $1 million, and that asset just keeps dropping and dropping, it's going to wipe out your entire capital. So in certain contexts, it makes sense, particularly in longer term passive investment strategies. If you're using leverage, it doesn't make sense, because it could work for you for a long time, and then that one time where it all breaks down, you're going to lose your whole account. So I don't know enough details to comment on this specific trader, because if he may be keeping his position size very small relative to his account. If that's the case, that's manageable. But if he's using leverage, if his size is going way bigger than an account and he's doing that, at some point, and you can even, you can get away with it for months, even years. But at some point, it won't come back. And that's the point at which everything you've done can get wiped out, with that type of strategy. So context is important for that. Again, you can add to a losing trade, but I say if you're going to do that, for example, make sure you plan out what you're going to do and still have your risk managed, so that always know what the worst case scenario is.
So the maximum set limit can be at certain point, and within that, what is the maximum risk with respect to the capital he can plan?
Sure.
And then he can do the same thing.
Yeah, so he might say, if he's trading gold, he might say, I'm going to put a trade on gold at say $3,000, and if gold comes down to 2,980, I'm going to put another trade there, and if it comes down to 2,970, I'm going to get out of both those trades because they have exceeded my risk limit. But it's already planned. You already structured how you would do it, which is different from just when a trade goes against you, just adding into it, which if done aggressively with leverage can be catastrophic to an account.
So he has to accept the pain of loss at some point in order to keep it for the long run.
Again, it depends on if he's managing his risk through size, then he doesn't have to necessarily use a stop loss, because his positions are so small that even if they went say to zero, he's got a managed size to that account. Does that make sense? In the same way, so that would be something of a hybrid between trading and investing, if you could call it. But generally, most traders, who do that, will always have a worst case scenario, and it's important to have that when you do that kind of strategy. If you're more passive long-term investing, it's not as critical, because you're not using leverage, you're never going to get a margin call, and you've got a long time period for your investment approach to play out. Yeah. Yeah.
Say we have discussed about averaging down.
Averaging down, yeah.
Yeah, but what is the best case scenario for adding to the pillars?
Yeah.
So I'll put it in a scenario where, same gold, let's say I have entered at 3,000 and it went up to 3,100. I was holding long. I could have closed my position with a greater profit at 3,100, but when it is coming back at 3,050 levels, can I add if I still have the bullish bias? How do I cultivate this kind of mindset?
I've studied some of the best traders in history that we know of, and one of the things they say is when you've crossed the boundary as a good trader when you add to your winners. So most traders a lot of them add to their losers, and that's not always wrong, but I do necessarily wrong if that strategy works for you. But it does seem to me that adding to winners is the way to really maximize your profitability, because it just goes contrary to our inclinations. We want to just take profit quick, but by letting profits run, as the maxim goes, the famous trading maxim is cut your losses short, let your profits run. Adding to winners in certain contexts, sometimes it's called pyramiding or averaging up. Again, you need to also manage risk with that, because The moment you add to a winner, it changes your risk profile. So, you know, you can't keep the same stop on the position because you'd end up with higher exposure. But when you catch a really good trend, so for example, think of position traders who've been long gold for the last year and who've been adding to it.
Yeah.
They're sitting on massive positions at the moment.
Yeah.
You know, so it's a very good strategy to use, but there's a process to that. But something I would definitely encourage to experiment with and eventually build into your system if you feel it's right for
what
you.
I have experienced myself is that when I add to a winning position,
Yeah.
let's say similar pattern which is moving in my side, and I've added that, right after adding the winning position, it is a bit shaky. Let's assume it's a bit shaky. I've seen the profit,
Yes.
and now it is, when it is coming down, it is doubling down.
It's a lot less comfortable.
Yeah.
Because when you add to a winner, you lower your average price.
Okay.
When you add to a loser, when you add to a winner, you basically, your average price gets further away.
Yeah.
Your break, you know, or whatever the break even was of the whole position. When you average down, it gets somewhat closer. So it feels more comfortable to do that. But I think the uncomfortable option on balance is the much better approach. Now, that's going to mean sometimes that you've got to allow some winners to turn into a loss. But if you stick systematically with that orientation, when you do catch your big winners, they're going to be massive.
Okay.
Yeah, but the willingness, you've got to then be willing to give open profits back, and a lot of traders just find that too painful, so they don't like to do it. Everyone, you know, again, I'm not saying this. What I'm saying is always wrong, but everyone's like, you know, as soon as a position goes into profit, move my stop to break even.
Yeah.
You know, we're not trading to break even. We're trading to make money.
Yeah.
So that kind of aggressive trading, there's a place for it. And you know, there's a trader who I really like. Many will have heard of him, called Tom Hugard.
Yeah.
He wrote a book called The Best Loser Wins, and he's got a YouTube channel where he trades.
Yeah.
And he marks the strategy of adding to winners as one of the reasons for his intraday trading success. He's got a very good track record.
Yeah.
So I'd encourage people to read that book. It's called Best Loser Wins.
Okay.
Yeah.
Thank you so much. So thank you so much for your valuable time and
Yeah.
suggestions for our audience,
Yeah.
as well as for myself. I'm just, keeping all the information when I'm trading. I'm not saying that I'm always keeping. I'm trying to keep all the suggestions which you have shared with me personally and in this podcast.
Yeah.
And I hope this helps to many traders to become successful and financially free. And let's wish them best.
Yeah, absolutely. Thank you.
Yeah,
All
thank
right,
you so
thank
much.
you.